This is an educational interpretation of the investment philosophy and writings of Howard Marks.
One of the most perplexing things about investing is that intelligence often becomes a disadvantage rather than an advantage. We assume that smarter investors, those with better education, more experience, and deeper analytical ability, should consistently outperform. But history shows us something different. Some of the most spectacular losses in financial markets have been suffered not by the uninformed, but by the exceptionally intelligent. This isn't an accident. There's a structural reason why smart people lose money in markets, and it has very little to do with their intellectual capacity. The problem is that intelligence, when combined with overconfidence, creates a dangerous illusion. It convinces people that they can know things that are fundamentally unknowable. It makes them believe that their analysis is more complete, their forecast more accurate, and their judgment more reliable than it actually is. Over the years, I've watched countless intelligent investors make the same mistake. They gather information, build models, analyze data, and arrive at conclusions they believe are soundly reasoned. And very often, those conclusions turn out to be wrong, not because the analysis was flawed, but because the future refused to cooperate with their expectations. Markets are not puzzles waiting to be solved by the smartest person in the room. They are complex adaptive systems shaped by millions of participants, each acting on incomplete information, conflicting incentives, and constantly shifting emotions. The first reason smart investors lose money is that they confuse information with insight. In today's world, access to information has never been easier. Financial data, analyst reports, earnings calls, economic indicators, everything is available instantly. And because smart people are skilled at processing information, they believe that having more of it gives them an edge. But information is not the same as understanding. More importantly, having the same information as everyone else does not create an advantage. It creates consensus. And consensus, by definition, is already priced into the market. And when you're part of the consensus, you're no longer investing. You're confirming what everyone already believes. If everyone knows that a company is growing, that a sector is promising, or that an economy is recovering, those beliefs are already reflected in asset prices. To outperform, you need to see something others don't. You need to have a variant perception, an insight that deviates from the crowd. But smart investors often fall into the trap of believing that because they've done thorough research, their view must be correct. They forget that thousands of other intelligent people have done the same research and arrived at similar conclusions. The second reason is overconfidence in forecasting. Smart people are particularly susceptible to this because they are rewarded throughout their lives for being right. In school, in their careers, in intellectual debates, their intelligence has consistently proven to be an asset. So when they turn to investing, they naturally assume that careful analysis will lead to accurate predictions. But financial markets are not like other domains. They are probabilistic, not deterministic. No amount of intelligence can eliminate uncertainty. Yet smart investors often act as though certainty is achievable. They build detailed financial models. They project earnings 5 years into the future. They calculate intrinsic values down to the decimal point. And because the math looks rigorous, because the logic seems airtight, they convince themselves that their forecast must be right. But a precise answer based on imprecise assumptions is still wrong. And in markets, the assumptions we make about growth rates, interest rates, competitive dynamics, and countless other variables are always, without exception, imperfect. What's particularly dangerous is that intelligence makes overconfidence more convincing. A smart person can construct an elaborate rationale for why their view is correct. They can cite data, reference historical patterns, and build compelling narratives. And because the story sounds good, because it's internally consistent and well articulated, they believe it more strongly. Other people believe it too. But a well-told story is not the same as an accurate prediction. Markets don't care how logical your thesis sounds. They care about what actually happens. The third reason smart investors lose money is that they underestimate the role of psychology. They assume that investing is primarily an intellectual exercise. Gather information, analyze it rationally, make decisions based on logic. But investing is at least as much about managing emotions as it is about analyzing numbers. Fear and greed, impatience and overconfidence, the herd instinct, and the fear of missing out, these psychological forces dominate market behavior, and smart people are not immune to them. In fact, intelligence can make psychological biases worse. Consider confirmation bias, the tendency to seek out information that supports what we already believe and ignore information that contradicts it. A smart person is particularly good at finding evidence for their thesis. They can construct sophisticated arguments that make their position seem unassailable. They can dismiss contrary evidence as irrelevant or misguided. And because they're intelligent, they do this without realizing it. They genuinely believe they're being objective when in reality they're engaged in motivated reasoning. The same is true for narrative fallacy, the tendency to create coherent stories that explain past events and predict future ones. Human beings are storytelling creatures. We need narratives to make sense of the world. And smart people are especially skilled at constructing narratives. They can look at a series of events and weave them into a compelling explanation. They can take disconnected data points and turn them into a logical progression. But just because the story makes sense doesn't mean it's true. And just because it explains the past doesn't mean it predicts the future. Markets are full of narratives. Technology is transforming the economy. Inflation is making a comeback. A recession is inevitable. These stories sound convincing. They're repeated by intelligent analysts, discussed by respected commentators, and embraced by sophisticated investors. And very often, they turn out to be wrong. Not because the logic was flawed, but because the future is more complex and unpredictable than any narrative can capture. The fourth reason is that smart investors often mistake volatility for risk. This is a subtle but crucial error. Volatility, the fluctuation of prices, is visible and measurable. Risk, the possibility of permanent loss, is not, because volatility can be quantified, because it shows up in models and metrics. Smart investors focus on it. They build portfolios designed to minimize volatility. They use sophisticated tools to hedge against short-term price swings. And they convince themselves that they're managing risk. But volatility and risk are not the same thing. A stock can be highly volatile and still be a good investment if it's purchased below its intrinsic value. Conversely, a stock can have low volatility and still be extremely risky if it's overpriced or if the underlying business is deteriorating. Smart investors, because they rely heavily on quantitative analysis, often conflate the two. They see low volatility as safety and high volatility as danger. But in doing so, they miss the real risks, the ones that don't show up in historical data or statistical models. The fifth reason is that intelligence creates an illusion of control. Smart people are used to solving problems. They're used to being able to figure things out through effort and analysis. So when they approach investing, they naturally believe that with enough work, they can control outcomes. They can identify the right stocks. They can time the market. They can avoid losses. But markets are not controllable. They are shaped by forces far larger than any individual investor, no matter how intelligent. This illusion of control leads to overtrading. Smart investors, confident in their analysis, make frequent adjustments to their portfolios. They buy when they think conditions are favorable. They sell when they think conditions are deteriorating. They constantly react to new information, convinced that their ability to process data quickly gives them an edge. But every trade carries costs, both explicit and implicit. And more importantly, frequent trading is often driven not by genuine insight, but by the psychological need to feel like you're doing something. The best investors I've observed over the years tend to do less, not more. They recognize that the future is uncertain. They accept that their analysis, no matter how thorough, is incomplete. And because they understand this, they focus not on predicting what will happen, but on positioning themselves to survive and benefit from a range of possible outcomes. They don't try to be right all the time. They try to avoid being catastrophically wrong. This brings us to perhaps the most important point. The real danger in investing is not ignorance, it's certainty. When you know you don't know something, you're cautious, you're humble, you leave room for error. But when you're certain, when you believe your analysis is sound and your forecast is accurate, you take larger positions, you use more leverage, you commit more capital. And if you're wrong, the consequences are severe. Smart investors are particularly vulnerable to this because their intelligence gives them confidence. They've thought through the problem, they've considered the variables, they've run the numbers, and because everything seems to make sense, they feel certain. But certainty in an uncertain world is a recipe for disaster. The most successful investors I've known are not the ones who were right most often. They're the ones who knew they could be wrong and managed their portfolios accordingly. There's a concept in psychology called the Dunning-Kruger effect. It describes how people with limited knowledge in a domain often overestimate their competence. But there's an inverse version of this that affects smart people. Because they're competent in many areas, they assume their competence extends to investing. They don't realize that intelligence, while helpful, is not sufficient. Investing requires not just analytical ability, but emotional discipline, humility, an understanding of market psychology, and a willingness to accept uncertainty. None of this means that intelligence is a disadvantage in investing. It's not. It's analytical ability, the capacity to process information, and the discipline to think clearly are all valuable. But intelligence alone is not enough. And when it's combined with overconfidence, with the belief that you can forecast the future or control outcomes, it becomes a liability. The antidote is not to stop thinking or to abandon analysis. It's to recognize the limits of what you can know. It's to approach investing with humility rather than certainty. It's to focus on avoiding mistakes rather than chasing brilliance. And it's to remember that in markets, being less wrong more often is far more valuable than being spectacularly right occasionally. Over the years, I've come to believe that the best investment mindset is not one of confidence, but one of skepticism. Not skepticism toward opportunities, but skepticism toward your own certainty. When you find yourself absolutely convinced that you're right, that's precisely the moment to step back and ask what you might be missing. What assumptions are you making? What could go wrong? How would you know if you were wrong? These are not comfortable questions, but they're essential. Smart investors lose money not because they lack intelligence, but because their intelligence convinces them they're right when they're not. They lose money because they confuse information with insight, precision with accuracy, and narrative with reality. They lose money because they underestimate uncertainty and overestimate their ability to control outcomes. And perhaps most of all, they lose money because they forget that in investing, humility is not a weakness. It's the foundation of long-term success.